Hello, hi there. My name is Jamal Khan, and I'm a senior tax partner at the Churchill Tax Group. I'm a chartered tax advisor, and I will today be talking about incorporation or transferring properties into limited companies, which is becoming a very popular topic. I have been advising on these matters for a number of years now, and I have helped with quite a lot of incorporations. In fact, we do this very regularly these days. So I'll talk about how what the benefits are, and what the traps are, what to watch out for, and things you need to be aware of when you go into a limited company. And once you've considered all the risks, the advantages and the disadvantages, then you can potentially make an informed decision on whether this is the right step for you or not. So I will start my presentation now. Here we go. So yeah, I mean, the topic of this is talking about incorporation, which in tax terms is equivalent to transferring properties into limited companies. This is a little bit about us in terms of who we are, what we do, but most of my audience that watches these videos is well aware of who we are and how long we've been operating for and our skill set in the organization. Incorporation, right. So the truth about incorporation, essentially people are, a number of clients are approaching me from across the country, say we want to transfer properties into limited company. Okay, and I ask them why, and then most of them have whatever different reasons, but generally it's to get tax relief on the mortgage interest, which they're currently not getting. It's very expensive to run the properties in your own name, or maybe you need just a better structure. Different commercial rationale behind this. Some people come to me with, say, 10 properties or 20 properties, and they say that they want to transfer it into a limited company. Some of them say, I have one property, I want to transfer it to a limited company, or 2 properties. In which case I say, no, that's not possible. If you can do it, so you can only transfer property into a limited company, but then you have a significant amount of tax to pay. If you've got a number of properties, then that's different. And I will talk about that in a bit more detail. So a few things to be aware of as you transfer properties into a limited company, which is owned by you. You have 2 taxes that apply. One is that there is a capital gains tax charge. The other one is that there is a stamp duty land tax charge. So the capital gains tax is payable by you as the owner of the properties. So you're essentially transferring properties into another legal entity. Even if you own the company, you still have to pay capital gains tax. And even if you don't charge the company any money, you still have to pay capital gains tax. And the stamp duty has to be paid by the limited company. And this could make the transaction very difficult. So that's the normal law that applies to this. However, there are some exemptions, and the exemptions that are available are if you've been running the property businesses, the property portfolio as a trade, then you would, and if you've been spending, say, a minimum of 20 hours a week, this is HMRC's guideline, although there's no legislative guideline, but this is HMRC's guideline. For 20 hours a week, then this, especially your property business, would qualify as a trade, as a business, not as a trade, but as a business. And therefore you could potentially be exempted from capital gains tax. And when, especially with people that come to me with 1 or 2 properties or 3 properties, and they say to me, "Oh, yeah, we are spending 20 hours a week," and I find that difficult to believe. If you've got more properties, then that makes sense, because you could potentially be spending. But if all your properties are being managed and there is no actual activity, then you need to reconsider whether this is the right step. Because if you get this wrong, and if HMRC subsequently inquire, then you can be in a lot of trouble. HMRC, if you're denied incorporation relief exemption, then you could potentially end up paying a lot of tax. The same applies for stamp duty. But for stamp duty, if you want to be exempted, the way around it is, if you have a partnership running, if you have and you've been filing a properly registered partnership, it's been running for a couple of years, and if you after the partnership has been running for a couple of years, you incorporate, then at that time there is an exemption available, which is under Section 75A, and that allows you to transfer properties into a limited company without having to pay stamp duty and tax, which is in my view quite a useful exemption. And both of these exemptions, the stamp duty and the capital gains, they're quite complex. I mean, I'm trying to simplify matters here, but you need to be very careful when documenting everything. The advantages are that once you've transferred your properties into limited companies, then you get full tax relief on the mortgage interest, and if you then decide to sell the properties at a later point, then the capital gain tax base cost for the properties is rebased to the date the properties were transferred into the limited company, which effectively means that you can sell the properties straight after the incorporation without having to pay any significant capital gains tax. So this is something that these are the main advantages. There are also disadvantages or risks that come with stamp duty, land tax, and capital gains tax. The risks I've mentioned for capital gains tax is if your HMRC prove that you're not spending enough time on this, then they can deny you the capital gains tax exemption. Or if HMRC look at this transaction, that this was designed to avoid stamp duty or taxes, then you can potentially be stung by stamp duty and tax charge under the anti-avoidance provisions. So this is something that you need to think about, and also if you have a mortgage, the mortgage transfer costs into limited company can be quite high. Once you are in the limited company, just be wary that you cannot take properties out of a limited company. So that's something that you need to be very careful with, and that they will be in there for forever, essentially, unless you break the company down, which will be quite costly, or liquidate it, which could be quite costly. So it's not a short-term solution. A lot of people think of it as a short-term solution, but it can be very expensive. Inheritance tax can be quite high. Inheritance tax, a lot of people come to me and say, "Oh, Jamal, I'm going to transfer properties into limited company, then I'm going to gift my shares to the children," which that doesn't work, because the gift of the shares will be subject to capital gains tax. So you need to be careful. You need to consult. You need to speak to specialists, or you can talk to me about your specific circumstances, because there are long-term risks associated with incorporation and or transferring properties into limited companies, and unless you've understood it fully, I strongly suggest that don't do it. And if you see the benefits, there are benefits for people who want to take advantage of the incorporation relief. Okay, so that's it from me. If you have any questions, my email address is there, my telephone number is there. you can get in contact with me. Thank you very much.